So next up, let's deal with the element and the effect. So the element you may need to know receivable since you're going to receive it, so it's an asset. Alright. Revenue is an income, cost of sales is an expense, and inventory is an asset. And then the same thing go. So you have this. And of course, this one is quite straightforward. And discount allowed is actually a expense because you give a discount, so you collect less money. It's as if like you lose money. Then finally, in terms of the impact, so when you sell, you're going to receive your money in the future. So it's an asset go up, you make your sales, you have an expense, and your inventory has decreased. So when it's returned back to you, it causes your income to decrease, your asset, your trade receivable will also decrease, and then your inventory go back up because you receive the goods back. And of course, it's as if you never make the sale, so your expense also decrease. And finally, when you receive your money, then of course, asset, cash at bank go up, and then you're no longer going to receive in the future, go down, and finally, you have this expense, so it's a plus. That is how we actually count with our debit credit. So that's why when you sell on credit, you debit trade receivable, credit sales revenue. These two is the same thing, same amount. Then you debit cost of sales, credit inventory. When there's a return, all you need to do is to reverse it. Alright, sales revenue becomes sales return, that's all. Other than that, it's a swap. So you debit sales return, credit trade receivable, debit inventory, credit cost of sales. And finally, when you receive your check, you debit cash at bank, credit trade receivable, and when you have a cash discount, there will be a new account which is discount allowed because the total of how much discount you receive, you give, and then the money you collected is the amount that you are supposed to collect.